Dear YouTubers, welcome to another episode of Real Turkey. This time, your regular host, Mr. Atilla Yesilada, and you see his situation room in the back, is interviewing his good friend, Mr. Erda Gercek, who has for long worked at Citibank and Legg-Mason. Currently, he's a founding partner of Thales, right? Is it Erda? Is it Thales or
Thales.
Thales Consulting and Educational Company. We are going to hold a discussion with Mr. Erda Gercek about the world, emerging markets, and finally, time permitting, Turkey. Erda, welcome to the show. It's a pleasure to host you here.
It's great to be here. After 18 years, you and I in the same frame again. It's fantastic to be here.
Yes. Mr. Erda Gercek also regularly contributes to the Turkish version of Bloomberg TV, and he has weekly shows which are widely watched. Erda, I want to start with the global outlook. There are recession fears. IMF yesterday published a paper saying trade wars would shave off 0.75% from global growth. What do you think about the possibility of global recession? How close are we?
I wouldn't bet on global recessions. They're very rare. If someone asks you whether it's going to be a global recession or not, just ask the simple question. How many global recessions have you seen since the turn of the 20th century? And the answer is very simple, 3 of them. Okay, and this is the First World War and the aftermath, the Great Depression, and the Second World War and its aftermath. So it's very rare. So I wouldn't put my money on having another global recession. Mind you, we didn't even actually have a global recession after the 2007-8 global financial crisis. There was just sharp slowdown in growth, but there was never a crisis.
Well, let's move on to the deflation, which may or may not come without recession. We have seen China factory prices today, the sharpest decrease in last years. No major country is close to meeting inflation targets. And the bond market either prices, a very sharp Fed rate easing cycle or global deflation. Where do you stand on that issue?
Well, two issues. Prior to the 1970s, where we had the inflationary shock on the back of the first and the second oil crisis, we had regularly deflation and inflation, and there was no particular trend to it. And that's why I think the world in a deflationary environment with the debt load is a problem, but we need to just distinguish between good deflation and sort of bad deflation. Debt deflation is the bad deflation. The fact that the prices may actually fall for a while doesn't really bother me as much as some other economists. On the other hand, I would like to say something more general and structural. Sure. I think we can, on the back of the IT revolution, digitization and everything, I don't think we can actually measure prices. Okay, we cannot measure inflation, the real sense of the meaning. So this is a very profound observation, actually, when you think about the fact that all the issues that we talk about are actually driven in some sense of inflation. Okay, if you take out inflation, you don't know what productivity is, what GDP growth is, nominal GDP growth is. So it's a very profound issue we need to think about. But I think sooner or later, central banks actually will face this issue. From the last Jackson Hole, we already hear Fed thinking about new ways to look at monetary policy. Maybe inflation targeting as it stands now is not the right way to actually conduct monetary policy. So this is a very, very profound issue, and one that requires a lot of attention over the next several years.
You're completely right. Technological progress has really just confused and muddied the inflation data. But I want to touch on another point that you have made, debt deflation. We know that led by emerging markets, global debt levels have risen sharply, and most of it is in dollar terms. Where do you stand about the EM debt? I mean, at what level of disinflationary process or recessionary process would you be worrying about debt defaults or contagious debt defaults?
This actually goes back to the issue whether current cycle or the cycle is about to kick in with new QE expected from from the ECB and everything, and how that's going to affect emerging markets. My answer is, again, a very structural answer to first, and then I will tackle the issue later on in a bit more cyclical terms. I think structurally, the concept of emerging markets are a misnomer now. Okay, when I mean, you know me, I had been managing emerging markets since early 90s. But by that time, I mean, emerging markets were real emerging markets. There was a theme. These countries were actually moving away from import substitution into export orientation, and they required a lot of capital to be able to make that transformation. So they just started liberalizing. So that was the concept of emerging markets. Okay, we sort of facilitated the opening of these markets to some extent through portfolio investments and so on and so forth. But nowadays, I mean, this emerging market is a very disparate set of countries. So rather than just basically saying that this is going to affect emerging market in such a certain way, we need to really pick countries. Okay, so the reality is this: if the slowdown, which is going to trigger sort of the rate cuts and QEs, is what we're worried about, okay, then we need to just basically worry about commodity producer emerging markets. We need to worry about Brazil's, and you can actually even put in Australia there, which has actually been producing very bad numbers. Okay, Indonesia's and Malaysia's and whatnot. Okay, but I mean, if there's no global recession or the fears of global recession, but it's just mild slowdown, I think there's no case for a debt default or debt deflation in the emerging markets world the way people define it.
Let's move on to trade wars before we get to monetary easing. Trade wars, do you have a scenario for the end game? How much more damage can the world economy suffer?
When this thing came out, in every single platform that I attended on TV as well, I basically suggest that the US and China cannot agree. And I just basically spelled it out several times. They cannot agree. Any agreement will be superficial. And I'm very, very surprised that the market throughout the summer has been actually trading on the back of, they started talking to each other. No, another one coming in. No, it's 5% increase in this and that. The reality is that we all know now that they cannot agree on it. Okay. And the implication is going to be very profound. Okay. And we spent decades putting this supply chain together and breaking it. Okay. And rewiring, for lack of a better word, the entire world trade is going to be very difficult, and it will take a very long time. And the genie is out. I mean, now all around the world, the countries are just basically looking at their China investments or the regional investments. And it's also creating mini trade wars. I don't know if you just basically cover the issue between Japan and South Korea. Okay.
Yep, to a certain extent, that para-analysis.
Yeah, I mean that's another issue. It can actually create many small trade wars here and there because, as I said, genie is out, and currency manipulation. I think United States actually picked on China in a very, very bizarre time, just naming it currency manipulator, because as we all know, they are no longer manipulating currency. If anything, managing your currency, trying to keep it fixed against the reserve currency is a very difficult issue, especially if your economy is slowing down. We all know that. So it's a very bizarre time. But I mean, to sum up, I think the whole concept is going to be very damaging to the world economy. Institutions like the World Trade is a very complex institution. When you break it down, it has a lot of damage, and we're going to suffer the consequences.
Well,
I want to put one silver lining, though. Okay,
sure.
One silver lining. I want to put a color around it if you have time to talk about it.
Sure, we have plenty of time.
Okay, this is the issue. I think it's about time for China to move away from the mercantilist policies they have deployed for a very long time, okay, and just started just basically growing on the back of domestic demand. I would take you guys back to 2009. Just before the crisis, okay, China was trying really hard to change its economic model because they realized that the world demand was not strong enough to absorb the productive capacity of China, okay? So they were going along that line, and then bang, the financial crisis hit. What do? They actually deploy almost $600 billion of fiscal stimulus. This is very, very underappreciated. If you ask anyone in the financial sector or economic circle, they will always say it was Fed which bailed the world out. That's partly correct, but China did a major, major contribution. Okay, their contribution was enormous in terms of creating extra demand, which kind of insulated some countries, particularly the commodity exporters, from getting hit by the financial crisis. Okay, but the problem is that $600 billion roughly created a massive capacity in China. And they actually literally went back to their old model, which they're very used to doing, okay? Just putting new capacity in and producing and selling, exporting to the rest of the world. Now there's another chance. It's a forced one. They get a sort of gun in their head trying to change their business model. They will do it, I have no doubt. It will have, as I said, some ramifications, but it will happen.
Okay, let's move on to monetary policy. ECB meeting on Thursday, Fed FOMC on 18th. Everybody expects rate cuts or some kind of monetary easing. First question, how far are these two reserve money central banks willing to go? B, would it help the world economy?
Let's just take the first one first.
Yep.
I think that when you're... let's talk about ECB first, okay? If your entire mandate is very simple, meet the inflation targets, okay, 2% or just below 2%, then doing nothing is not an option, okay? You're going to do something. You're going to keep delivering QEs and rate cuts and this and that, and tier the rate cuts, whatever you can do to make sure that at least you look like you're getting there, okay? Are they going to hit the inflation target? Very unlikely. Does anyone believe that they're going to sort of hit their inflation target? I don't believe so. Okay, so they keep just basically over the medium term, they're going to reach our inflation target. It's just not very likely. But going back, is it that important? I don't know. What's more important is the nominal GDP. Okay, are they reaching their nominal GDP for targets? Ex-Germany, perhaps.
Right.
Okay, Germany. Answering your first question, digging Germany out of its just slump, predominantly because of the trade wars, okay? They are the sort of bycatch, for lack of a better word.
Collateral damage.
Collateral damage. But I mean, they have themselves to blame. That's another issue. We can talk about it in another time. But reality is that they need fiscal effort, okay? They have enormous room for fiscal expansion. 50 billion euros, their earmark is not enough. They need to do 10 times of that, okay, which will help them and for the rest of the Eurozone. So it's not about monetary policy. It's just all about fiscal policy, not only for Germany, for the entire Eurozone and the emerging markets, okay? We have to move away from expecting too much from monetary policy. It has reached its limits, okay? It's doing a lot of damage in Eurozone to banking sector. We all know that. That's why when they announce their rate cuts, they need to just come up with a tiering system to make sure that some banks are not get hurt, okay? But reality is that it's very unlikely that it's going to dig themselves out of the current slump. And again,
go ahead.
Ex-Germany, Eurozone is not doing that bad, okay? Even Italy is hanging in there. When you look back over the last 10 years, Italy cannot grow, and because of demographics and whatnot, but it's just still struggling and it's still in there. But I don't think it's a monetary policy issue anymore.
Let's look at Fed. Never mind the September of 18th FOMC meeting. To the extent I can understand it, derivative markets are betting for 4 more rate cuts through 2020. Do you see a case for that, or would Powell disappoint markets?
Well, it's very difficult to gauge. I mean, to be honest with you, I was dead wrong about what Fed was going to do. I didn't think, and I still don't think, the United States economy requires this many rate cuts. I didn't think it actually required any rate cuts. It's what we call a continental economy, okay? It's not a trading nation. It may actually look that way.
It's almost a closed economy.
Yeah, and look, I mean, we look at the S&P 500 companies, and we got really the sort of get a very ill understanding of the U.S. economy. U.S. economy is all about small mom and pop shops, service sector, and everything, and it inherently interest rate insensitive. Okay, cutting interest rates is not going to really help this economy. That's why I was very, very surprised to see Fed cutting this way. When you look at the TIPS, Treasury, inflation, protected securities, when you look at the yield of those, because they're actually taking out inflation, it actually tells us that market's expectations of real growth is in negative territory now. Market is really worried about growth. When we actually look at sort of each and every sector, okay, turning every stone, we realize that growth is not as bad as people think it is, okay? That's why, answering your question, at some stage, if Fed is genuinely data dependent, they're going to have to stop cutting interest rates. And also, one more issue that's been now talked about, inflation is not as low as just sort of demanding so many rate cuts, okay? So US is a very, very different ball game, and I don't think they should be just sort of using all their bullets at once, okay? We may actually run into a sort of a global event which may actually cause sort of a recession. Then we're at rock bottom interest rates. What are we going to do?
No, I agree with you. I don't think there is a case for sustained monetary easing, but from that point, I want to move on to non-developed markets, since you don't like non-developed, those outside the developed markets universe. There is a lot of debate to the extent I can decipher it. On one hand, some investors expect a lot from monetary easing in terms of pushing money to the EM markets. Others think growth is the backbone or the mainstay of EM market, and it's moderating everywhere. So how do you see the future for the emerging markets? Are they going to attract a lot of financial capital? Would that help their growth rate?
Again, I will dispute today emerging market comments.
Right,
okay?
Yes. Okay.
Yeah. Look, we need to really distinguish between it.
So classify them and,
Okay, commodity exporters, one way to look at it, commodity exporters, commodity producers, okay? Commodity exporters, if the economy slows down as market expects, okay, then there will be some difficulties in those economies, okay? They need to just basically deploy a massive amount of fiscal stimulus, okay, to be able to stay afloat, okay, which requires some financing further down the road. But mind you, let me just step back a minute, back to the developed markets, okay? And I didn't answer your question entirely. If you consider the fact that very large part of developed market debt is in negative territory now, okay? If you look at German, entire yield curve is in negative territory. By borrowing more, you're actually making your debt disappear.
True, because they're paying you to buy your debt.
So as far as emerging markets are, bringing it over to emerging markets where inflation is still there, okay? So what we're after is nominal GDP growth. If to the extent that they can boost some growth with the normal levels of ongoing levels of inflation, then nominal GDP is going to be higher than their nominal interest rates they're paying on their debt. So it's not too bad. If they're indebted, all right. They didn't use the good times to actually restructure. Fine, I agree with that. But generally speaking, the countries are in not as bad shape as they used to be.
How about the exchange rates? Dollar strength has been surprising to many analysts and commentators, and it continues even though Trump is causing most of the problems. In a scenario where Fed cuts once or twice or ECB provides further stimulus, do you see dollar or euro weakening emerging markets affects appreciation?
Everyone who knows me knows that I categorically deny talking about currencies, okay? Because I believe currencies are not forecastable. Having said that, just to put some color, okay? I mean, we generally, Thales, we were expecting dollar to strengthen to some extent, okay? And the currency markets goes to two regimes. One we call drift, they drift. I think at the moment, euro dollar has been phenomenally stable, okay, compared to what's happening elsewhere in the rates market, okay, and the volatility sort of in the equities, for example, okay, and they go through trend. Are we in a trend now? It's very difficult to call euro dollar just looking at the market as it stands now. That it's an upward down trend. Okay, it's very stable. It's very important. That's very positive news. As you basically suggested, dollar strength globally is very deflationary because as dollar strengthens, as I said, as per our comments on China, as dollar strengthens, one thing you don't want, okay, is try to manage your currency against the reserve currency, which is the dollar. Okay, you're gonna have to let your currency depreciate at least gradually to the extent you can. Okay, so you need it's a de facto monetary easing as well to having a sort of a weaker currency. And I'm sure Mr. Draghi is sitting there and just in his chair and basically saying that at least after all this time, one thing I got right was to weaken the currency.
Mm-hmm.
This is by far the most important achievement if they achieve that. Okay, that's the one. Okay, if you just basically pick one thing that the ECB did, they actually weakened the currency, and that's very important. Okay, and they will love to see, to the extent they can, they will love to see the currency continue to depreciate against the US dollar. But as you basically pointed out, whether sort of political strategy will allow further appreciation of the currency, US dollar, is something we need to see. We now know that intervention of the US dollar market was actually discussed, okay, several times in the end, and they decided against that. At the moment, there are no signs that US economy is being damaged by the strength of the US dollar. Okay, but we will see. This may be part of the trade war at some stage that they may want to talk down the dollar, and I hope not.
And that would be a coordinated action, presumably, not from Trump, but just major reserve bank nations coming together.
Yeah, I mean, we're talking about another plaza occurred, but reality is that, as I was just basically alluding to, it's very difficult to see how ECB can allow a long run appreciating in euro. Okay, it's going to be very, very painful. It's very difficult to restructure economies under strong currencies. Okay, unless you're, as I said, like a US economy where you have the reserve currency. So coordinated action, no. What will benefit euro? What can benefit euro is that if Eurozone's really sort of tail spins into another slowdown, okay? The monetary policy is ineffective, fiscal policy doesn't kick in because of master criteria or whatnot, okay? And perversely, you will see euro appreciating, okay? Because there will be massive amount of repatriation into the Eurozone. A lot of people wonder why yen is a safe haven currency. It's a safe haven currency because when Japanese institutions get worried about what's happening around the world, they start repatriating the currency back. As a result, okay, you actually have appreciating yen. The same dynamics can happen to Eurozone. So those people who actually think that weakening Eurozone economy will lead to more sort of weakening of euro, there's a limit to that. Okay? We should bear that in mind.
Let's move on to Turkey. Growth currently very low. The government wants to boost it up to 5%. What's your outlook on growth? Can Turkey once again grow fast as it did post the great financial crisis?
I actually leave the Turkish comments to you. You're much better at just basically gauging. Although I'm actually sitting in Turkey, it's not sort of entirely my sort of area of focus at the moment. One of the things that's in terms of growth, what we need now is balanced growth. Just going out for growth at any cost is not a good idea. And I think we should just basically continue to just head for balanced growth. Year-on-year numbers will look much better. Okay, so to the extent that global backdrop remains, as I basically sort of portrayed, the economy is slowing down, but no global recession to start with, and no US recession. monetary policy is on an easing track. That backdrop is relatively positive for Turkey. Okay, relatively positive for Turkey.
How much do you think central banks should cut rates? Not on Thursday, but in general.
Well, I think, again, I'll generalize that question. All around the world, okay, as the global economy slows down, as trade war starts biting, okay, all central banks, which, I mean, by the way, the Reserve Bank of India was the first one to actually started cutting interest rates in emerging markets. All central banks will cut. As I said, when the Reserve Bank cut, I just said all emerging market countries, central banks will cut opportunistically, okay? So what most countries will do is they will cut and see how their currency is reacting, how their market's reacting. So it's just a toe in the water approach, and they will continue to do that. And I don't see why Turkey should not be following the same path.
Okay, final question, once again, stated in as general terms as you wish. What's your outlook for the currency against the IMFSDRs? If you
Turkish currency.
yeah, lira it's called. I don't know if you use any, but
when you say currency, I didn't quite understand. It's a currency. I mean, again, it will be determined by the international environment to some extent. Local dynamics is you're sort of better gauging that. Okay, better at gauging that. So I would just basically say that international environment will have major sort of implications for the Turkish currency as per the other countries as well. If you were earlier alluding to a whole-scale US dollar rally to parity, maybe below, then sort of we will struggle as well.
Okay.
But we need to bear in mind that anyone who actually went abroad during the summer holiday will testify that Turkish lira is extremely cheap. Okay?
There is no doubt about it. Yes.
Yeah, I mean, in any metric, I'm just basically, I'm not just putting out sort of real effective exchange rate or this the sort of the Big Mac index. Just go out, okay, from where I'm standing, just go out to Greek islands, okay, you will see, we used to go to Greek islands because life was a lot cheaper there. Now you go there, it's very expensive, okay, yeah. Everything is euro denominated. So if you're betting against the currency, you need to bear in mind that it's a very cheap currency.
Okay, Erda, thank you very much for joining Real Turkey broadcast.
Real pleasure.
We would like to see you again, and your great beard. You look fantastic on screen, by the way.
Thank you very much. I appreciate that. And
dear YouTubers, we just finished another episode of Real Turkey. I am Atilla Yesilada, your regular horse. Your regular horse, and Hippo. This is our situation room. If you like our broadcast, please share. Otherwise, have a good day.